Okay. Hi. Hey, everyone. Hey, thanks for joining me on this live. It's great to be here. Uh, well, sorry about that. We'll take it from the top. But hey, it's great to be here on this live today. Had a little trouble getting started, but it's awesome to be with you. Um, Thanks for joining me. And we're looking for a title, I guess, of the lives. We're going to be here on Tuesdays, um, 2 p.m. Central Time. And just to talk about your money. Because the topics we discuss here on the channel are life insurance, finance, and tech. And today I want to get into the topic that seems to be just on the news and everywhere are the bank failures. So you started out with SVB out in Silicon Valley. Then we ran into Signature Bank on the East Coast in New York. And yesterday, Credit Suisse was brought up by UBS. So Credit Suisse was brought up by UBS. So why the rash of failures? And so, you're looking at the title, Inflation Explained, How Rising Interest Rates and banks breaking could take your job. So we have to go back to the pandemic and, what was the response of the government and the central banks? So at the start of the pandemic, after they figured out it was going to be more than 2 weeks to slow the spread, if we all remember that one, you start having some fiscal policies, some policies take place. And one was on the fiscal side, and then there was also monetary policy to go along with it. So in fiscal policy, these are policies that are actually enacted by a legislative branch of government. Here in the States, it was Congress. So Congress, along with the president, the executive branch, they shut us down, if we all remember. They just told us to stay inside. So you stop the velocity of money just cold. You just stop money from moving. And the rest of the world followed suit. So now what are you going to do that you've got people locked up in the house? They can't go out and earn. They can't do their business. They can't run stores. So your response is to eventually start giving out stimulus checks. Again, that was the arm of government. They start giving out stimulus checks. So in concert with this, you start getting monetary policy, which are policies that are enacted by a central bank. The central bank here in the US is the Federal Reserve. So the job of the Federal Reserve is to maximize employment, stabilize prices, and to moderate long-term interest rates. Now, the second one is going to be real important, stabilizing prices. So we'll go back to that one later. So the Federal Reserve does two things in order to get more money into the economy, because they've stopped people from working. They've stopped people from doing business. They've stopped landlords from collecting rent. They've stopped mortgage companies from collecting mortgages. They just put a stop. People can't earn, and even individuals who own hard assets can't gather money from the assets they own. Because remember, the rent moratorium. So the Federal Reserve, in order to get more money out, if it wasn't enough with the government just sending you checks, they removed the reserve component from the banking system. So the reserve component says that you have to keep a percentage of money on hand of the actual deposits, so that when people come in looking for their money, that there's actually physical dollars within the bank. So I think the requirement even at that time was less than 2%. So they brought it down to zero. So they bring it down to zero. You don't have to have any money on hand. So now you've got this flood of money entering into the economy, whether it's from individuals receiving an additional $600 a week for being unemployed. You've got PPP money coming from businesses of all sizes. The banks no longer have to hold in reserve. You've already got very, very low interest rates. The quantitative easing, making it easy to gather credit. So you have all this money that doesn't have anywhere to go. And that is just the definition of inflation. So inflation is too many dollars chasing too few goods and services, because you've shut down the goods and services because nobody's producing anything. We're not getting imports. We're not going to our factories unless they've been considered essential, which is usually food, food was the only places that were still physically producing things. You still had things on sale. People were delivering things to your car like Best Buy and places like that, and you're still going to grocery stores. But the production facilities, unless somehow they got the magic handshake to produce goods, they were shut down. But you've got all this money flooded into the system. So eventually, at some point, you're going to get inflation. So it starts up. Eventually, the Fed figures we have to do something now. We have to do something. The prices are rising, and so they do the first interest rate hike. So, okay, now, because one of their mandates is to stabilize prices, and pricing has gotten out of control. The prices are going up, oil, food, fuel, food, gas, they're getting out of hand. We got to do something about that. And so what we're going to do is that we're going to raise interest rates. We're going to try to draw money out of the economy. And we're not going to do this by, let's say, by increasing taxes or cutting government spending. No. We're going to go pure fiscal policy. We're going to go pure monetary policy. These are rules. These are policies enacted by the Federal Reserve. And the only one that we're going to really concern ourselves with is price stabilization. So we're going to stabilize prices by drawing money out of the economy. We're going to make it more difficult to do business. We're going to tighten credit, and you tighten credit by raising interest rates. Because once they raise the cost of funds to banks, it's going to affect you, because your credit, the cost of you borrowing money is going to go up. The cost of the banks is going to go up. And more importantly, the cost of the people you work for is going to go up. They're not going to be able to bring in new material. They're not going to be able to build new factories and things of this nature, because now it costs more to do so. Got to remember, we've had over a decade of basically zero interest rates. So a big problem there. And that's how it's going to lead into this bank run is now going to affect your ability to work, because businesses can't borrow. The flow of capital is going to be constrained. Businesses can't grow because the Fed doesn't want them to, because the Fed wants the prices to go down. That's going to lead to you having difficulties working, the layoffs. So more layoffs are coming. So I've spent about 8 minutes with doom and gloom. So what can you look forward to? What can you do to mitigate some of this? If you live long enough, this isn't the first recession that I've seen. And I'm not that old. I'm Gen X. So there's been several of these economic downturns. And one thing that we talk about on this channel is always just get your money right. And one of them, yes, is to actually lower your debt. Because if you notice, your credit is becoming more expensive. The revolving credit card, remember, you agree to an increase in your credit, you agree to an increase in your interest rate when you use the credit card. They don't even have to tell you. They can change your rate at will on revolving credit. So one thing is to bring that consumer debt down. The next thing to do is to actually increase your income. Diamond Dave has said it. I didn't come up with this saying. Get some skills or take the deal. What is happening now is that great binge of hiring that occurred, particularly in the last 2 years or so, because of the pandemic, particularly in like delivery services, Amazon, various places like that, the layoffs are going to increase because, again, the economy is going to contract. The economy, the the Federal Reserve wants the economy to contract because they want to bring prices down. Their primary concern is price stabilization, not moderating long-term interest rates, and certainly not maximizing employment. Because to them right now, prices are the primary concern. The Fed chairman said so in the big meeting at Jackson Hole at the beginning of the year, and he's keeping his word. You may ask, well, why is this affecting the banks so? Well, banks do borrow money, but banks also, they make investments also. So when they went out, when you had this big splurge of money, they had all these dollars they had to do something with. Many of them bought treasuries, whether they were short-term or long-term. The interest rate, again, that is the interest rate on treasuries is the amount that you earn in interest for purchasing the bond. Well, they were sitting at like 1.25%, 1.5%. Well, the new treasuries are coming out at quite a bit more. And so what you once had on your books as an asset, as a backstop, it isn't anymore. They're simply not worth what you pay for them anymore. So let's say there is a run. Folks are coming in and they want their money. One, you don't have the amount of reserves that you used to be legally required to have, because you're not legally required to have those reserves anymore right now. Secondly, the things that you could move to possibly pump up in a short time is to sell treasuries. Well, nobody wants your treasuries because they're not paying what the new treasuries are paying. So basically, you got bad debt on your books that used to be an asset and now has become a liability. So you can't meet your requirements to give the money out. That's where the bank runs come in. You have things that were once assets that aren't assets anymore. And hence liquidity problems. Nice way of saying you're broke. How is this going to affect your job? Just told you. When credit is tight, it is difficult to borrow and it's difficult to expand. You need a fluid credit market for job development. Then we come in with the fact that the government, instead of cutting back on cost and lowering they're going to pump more dollars into the economy. So there's some other reasons, some long-term factors about why inflation is going to continue. It's what the Fed doing is not going to, it may slow it to a point, but it's not. There's some long-term things going on in the economy, and I'd love to discuss them with you. There's a couple of books that I think I'm going to put down below to go read to why inflation, particularly here in the U.S., is going to continue for the long term. Because one, it has to do with actually the reshoring of jobs and governmental policy. You're coming out with the retooling of bridges and so forth, and then you're reshoring quite a few jobs back home over the long term in tech and various things like that. So, and the build out and some of the things that the government is planning to do, it's going to keep inflation. So we're going to stay inflation. So going back to those halcyon days of 2% inflation, and then decent, 3% growth, I don't see those returning. But that's just what I wanted to talk to you about. I didn't want to be so gloom and doom, but those of us that watch those of you that watch the channel, you watch for answers, not just, oh, it's bad, it's terrible, it's not going to get any better. It is on your level, because you control your own personal economy. And one is to develop your skills to where the market pays you for what you want. Those days of, I don't know, going to work and not doing much, being a forklift operator and things of this nature. I got nothing against forklift operators. I should be one myself, but you're going to have to improve your skills. Tech is where it is. So hey, how you doing, Kim? Watching from the Philippines. Awesome to have you here. So is to get your skills up, and then the money that you do earn, that you do bring in, you're going to have to put to work. And those are the things that we talk about here on the channel. Finding investment opportunities and taking advantage of them. So it's more than just budget, save, because you can't save your way to wealth. But you can prepare yourself for what's coming, because it's coming. No one's coming to save you. So the bailouts for the student loans and some other things, that's not helping. That's not changing things. Hey, Mike, how you doing, man? Hey, you're right. Start a business or buy a business. That's it. Those are the three things: cash flow in real estate, investing in the market, particularly cash in dividend stocks, and start a business. Or the skills that you are selling to the market, if you choose to be a 1099 or a W-2 employee, just make sure they're a high-paying skill. And there's a lot of them out there. And don't let age try to be an excuse. Oh, I'm too old. No, they don't care. Whether it's in software development, whether it's in learning Linux, tech sales, technical writing, the world of IT is massive and the pay is good. So, and it's a way to earn funds over the fixed cost that it costs you to take care of yourself, to use your funds to start investing, to do some of those things that we just talked about. So so that's primarily what I got for you guys today. I don't want to stay too long and just beat the drum, but I keep saying about the banks and the fear, and there is a contagion. Because remember when they came out, when SVB went over, I think we're now about 10 days out from there, that they said they had stopped the contagion, which is crazy. Because the very reason that the bank is experiencing issues, other banks are going to have the same problems. They're going to have the same problem. The interest rates and what the new treasuries are going for in the market makes treasuries that you had on your books that you once considered an asset are now not an asset anymore. They're liability. You can't get rid of them. Tie that in with that they have been allowed to get rid of their reserve rates down to zero. You got liquidity problems. And more of the stuff is going to happen. And you're going to see more banks coming in the issue. And with the belief that they're not going to backstop these banks, the federal government can't do it. So I think we're coming to a point where you're going to start seeing fewer banks, because the regional and the smaller banks are going to have problems. I think maybe next week we'll talk about what Janet Yellen said to Congress in regards to what banks are going to be backstopped and what banks are not. So, I mean, I certainly don't see them allowing Bank of America or Chase to have any issues, but that local credit union that helped you get your business started, that knows your name when you walk in the door, I don't know if they're going to come in to save those guys beyond the legal requirement of $250,000. That's with the FDIC. So that's what's going on now. So, and again, fear is not what needs to happen here. It's you coming up with a plan and as to how you're going to fortify yourself by what's coming, because it's here already. And there's no government plan that's going to get you out of it. It's going to be no executive order that's going to remove your debt or that's going to fix your rent. That's another one I wanted to come on quickly and talk about. Why the rise in rent. Again, this has to do with the amount of money that rushed into the system during the pandemic. So you got all this money, right? And people are trying to find somewhere to investors are trying to find somewhere to put it. So the two places was the market itself, stock market. Remember, stock market remained strong pretty much through the pandemic. And real estate, particularly cash flowing real estate, where you're buying for investment purposes, not to live in. Well, as these things became more valuable, And then you've got the long-term part of that. We're simply not building enough structures. We are nowhere near, I think the height, I'm going to have to get the graph and show it to you. We were building quite a few houses between 2006 and 2008. And we have not reached those levels. And we're almost 15 years after that. And we're still not back to building houses at the rate that we were building at that time. And just structures, period, whether it be houses or apartment complexes. You bring that in, and you get an increase in rents. Again, get a skill or take the deal. The rents, this particular market of housing, of the cost of housing increase, this is not like 2008. So expecting some bubble to burst or there's going to be a major crash, you may slow the rate of increase, like in some of the super hot areas, like Austin was one here in Texas. But the type of 2008 crash where you have a massive loss in value in houses, that's not happening. Not in real estate. That's not happening. So again, get the skill or take the deal. That's what's going on with the banks. I think you're going to see more. There is going to be more congressional hearings because it's going to get worse. The simple, what they had on their books is now bad debt. Much in the way the mortgage-backed securities were a problem in 2008. The treasuries that were always considered very stable, and in a sense they are, because they're still going to pay off. They're just not as valuable as they once were. They didn't hold their value because of this drive to bring down inflation. And although the banks are having some issues, I think old boy is going to hold, he's going to stay 10 toes down on raising interest rates again. I see another, 5 basis points and possibly more increase. He sees his job primarily is to get prices under control, and the rest of that stuff be damned. So blood in the streets. I agree with you there, Michael. I agree with you there, buddy. So look, again, I'm so glad you all came to check me out. It was awesome talking to you. If you have any questions, hey, put them down below. Hey, I like talking to folks. And we've got a Linktree there where if you want to come in and meet with me, that's cool too. Let's see. If I got to figure out a way to get that in the Linktree. My Calendly link where we can get together and talk, and you can we can go over what you're doing and what you're playing and what I see coming forward out there. So you take care of yourself. And this is Daphne Jones, and this is Smart Money Chick TV. And remember, keep it basic, keep it simple, and get insured. I'm out of here. Bye-bye now.